despite multiple geopolitical threats globally, markets have managed to climb the wall of worry for most of this year. But our next guest says is a major underpricing of the risks that are out there. For more, we're joined now by Kenneth Courtis, chairman of Starfort Holdings, managing partner at Courtis Global and Associates, and former vice chairman at Goldman Sachs. Asia, that's a mouthful. Welcome back to the show, Kenneth.
Thanks, Randy. It's a pleasure to see you.
I agree with you. I think there's too much complacency right now. I think geopolitically, you look around the world, there are hot spots, but we've become so used to, over the last 4 or 5 years, that everything turning out okay, that I think that's just the default position right now. Do you agree?
You know, markets are sort of made insensitive by all of this money that central banks have been printing. And that's what creates this ability to absorb basically any shock, because there's so much money just willing to get back into any asset as long as there's a yield a little bit better than the yield you're getting for money in bank accounts or on government bonds. So in a sense, there's a lot of complacency, but it's a bit of an illusion, because it's the moment that the central banks, and I'm talking about Japan, the US, the ECB, the Bank of England, the moment that they together start pulling back on this liquidity, then I think the complacency will start to chip away quite early, because there won't be all that money on the sideline waiting immediately to come back into markets.
But can we see, and I agree with everything you just said, but we see a minus almost 3% print on Q1 GDP, and those who think it doesn't matter say it's in the past, who cares? And yet at the same time you wonder, at what point do the central banks lose the ability to control the dialogue? At what point do the markets look at the billions and trillions of dollars that they flooded into the economy to get a minus 2.9 print on GDP and say, you know what? Maybe they don't know how this is actually going to play out at the end of the day anyway.
Randy, I think that I would say it slightly differently. Had the central banks not pumped in these gazillions of dollars into the system, we wouldn't be minus 3%. We'd be minus a lot more. So that's sort of point number one. And we did have a pretty cold first quarter, so that's in the numbers. I think what people are discounting, you know, there's this permanent optimism in markets that people want to be optimists, brokers want them to be optimists. And of course, with money free, in a sense, for people who can get it, they can be pretty optimistic. But the reality is, if you start to look a little bit more closely, the Fed has revised down 3 times the growth forecast for the U.S. this year. The IMF has just come out with a 2% forecast for the U.S. this year. Remember, initially, the Fed was looking at 3.2% for the U.S., so 3.2 versus 2% is a big move. So I think that's another reason that interest rates are coming down, is that there's just not a lot of growth in the world economy, and it's undershooting expectations, which makes bonds really attractive. And because interest rates have pretty much converged in the major markets, it's taken a lot of the volatility out of currency markets as well. And finally, that brings us back to equities. With all kinds of money available, interest rates falling, not much of that money being absorbed, or not great parts of it being absorbed into the real economy, there's just so much cash out there looking for a little bit better yield. So if you have a dividend stock that's giving you 3.5%, that's a lot better than nothing on your deposit in the bank, so people are rushing into the dividend stock. So I think that's how it all fits together.
Ken, that's how it all fits together, and we continue to see that play out. I think the big question, though, for so many investors is, how long can that play out for, and what might be a catalyst to take it down the other way, and or a risk? What's one of the biggest risks you're looking at right now?
Well, the biggest risks, Catherine, are always the risks you don't see and you don't expect, the sort of the black swans. And I think personally that political risk is highly underpriced in these markets. That people are, investors are, I don't want to say naive, but they're complacent to this political risk. Let's take some examples. We know that China has now entered into a big phase of domestic transition that's going to be complicated, to say the least. And there will be lots of bumps and humps and broken China, if I can use that pun. And so the Chinese leadership is going to run into lots of opposition. And so to offset or preempt the possibility that that opposition attack them for being weak on foreign policy, the Chinese government is going to be extremely strong and forthright on foreign policy. On the other hand, just across the water, you have Japan, a very nationalistic government, sort of backward-looking, that's talked a pretty good game about economic policy, but in reality has done nothing. Real income is contracting. Japan is going nowhere, basically. And Japan today, at least its current leadership, doesn't really trust the United States, doesn't trust the commitment that the United States has to protect Japan in the event that there's a clash with anyone, for example, with China. So the Japanese government, I think, is being deliberately provocative so that they can tie in the Americans in case there is a clash with China. So you could have something like this hit the markets, which nobody's expecting. If the three biggest economies in the world had a clash, even if it was only for a few days, that would shake up markets. So I think it's more something like that, and then the ricochet effect that the markets aren't prepared for.
Ken, are you then saying that the situation with Ukraine and Russia, and of course the situation, the geopolitical tensions in Iraq, are not as where we should be focused? The focus really should be in Asia right now in terms of potential conflict and catalyst to the downside.
Yeah, I see this cesspool of corruption that's disguised as a state called the Ukraine, and as you know, it's the center for the redistribution of 90% of the drugs that are produced in Afghanistan. I see that in terms of geopolitical risk as a sideshow. I mean, if you had been Putin, what would have you done? Would you have just sat in your hands and looked at the prospect of your only warm water fleet becoming a NATO port? Obviously, he had no choice and was well prepared. No one was killed. I think, you know, we have to look at the realities of geopolitics and sometimes be realistic, a little more realistic than maybe some of our leaders are. The Middle East is a big game, so that could, we have the collapse of the post-Ottoman state system. The state system that existed up until the end of World War II is now basically collapsing across that region, and we don't know what's going to come out of it. Luckily, and this is what I think is allowing investors to be rather complacent here, is everyone's thinking, wow, the U.S., North America is going to be energy independent. We don't need to worry about the Middle East. Well, I think that we're writing off this dynamic a bit too quickly. But the real focus should be on the parts of the world where the economic stakes are the highest, and about 65 to 70% of the world economy is in the Asia Pacific. So if anything goes wrong, deeply wrong in the Asia Pacific, that then impacts everyone, and it impacts everyone big time.
Ken, we only have about 15 seconds left, but we saw Abenomics unveil the third arrow again with some more detail lately. What do you think? Is it going to work? Are they going to hit a 2% GDP in the near term, or are they another decade of malaise?
2% real, they won't hit it the real term anytime in my lifetime.
Ken, we have to leave it there. Great to see you. Thank you so much for joining us again on BNN.
Thanks a lot.
That was Ken Courtis, chairman of the Startford Holdings and managing partner at Courtis Global and Associates. Well, still ahead, the New York